The Rotary Club of San Dimas for August 31st, 2022. Hey, we had some exciting stuff go on this weekend. So the first thing up, I want you to see what we did. Clark here is a disabled American Vietnam veteran from the United States Army. He is, part of his disability is being a hoarder, and along with the American Legion Post 309, the Elks Club of Glendora, the San Dimas Masonic Lodge, we tackled this problem with about 60 volunteers on Saturday. This is what we started with, and he's definitely a hoarder. He's currently hospitalized, and Clark will be moving to Ohio to live with his sister once he's able to sell this house. But you can see what we started with as the volunteers continue to clean and truck stuff out. And so we'll get to the part here where we're cleaning up in a moment, but I just wanted to see how tough it was in his house. And so there you can see early in the morning as we got there, we began to set up. That bougainvillea there is an actual tree that we chopped down to make access into the front door. A lot of people worked on just smashing up old stuff. We loaded, you'll see the big dumpster out there. We loaded up 10 of those with debris as it pans around to the other view. You can see the corner of it there is one is already loaded up, and we're beginning to load another one now with just debris, 70 years worth of keeping everything. It was hot, but the Star Post did bring us pizzas. And you can see we were chopping down the bougainvillea. We were loading up the dump truck. That's the completed truck. There were some people taking a break apparently at one point. I didn't get that part. The best part was that when it came to taking the group photographs, the Rotarians who got there early in the morning, because this is late in the afternoon, you can tell by the shadows, we had already completed all the work and had left. But that's what it looked like once we had cleared out the house. You can see now through the moving video that there was still some work to be done. There'll be another weekend scheduled. And when we get information from the American Legion, we'll help them again with Operation Cleanup for this veteran Clark at his home. And that was, as you recall in the early images, that was completely filled with 70 years worth of, well, living. Now it's completely cleaned out. There will be a cleaning crew come in to clean that up. And then that's already set to be sold. Hopefully it will sell quickly, and Clark will benefit from the proceeds. This is one of the community service projects that we completed last week. We had a lot of fun just working together with the Rotarians. 6 of us showed up from the club, and that was very cool to work all morning. About 1 o'clock we were done. Some of us got there as early as 6:30. You can see the forest that we had to take down to get access into the house. I personally have scars all over my arms from the bougainvillea. So that was this weekend with Clark, and that was a very cool thing. And now we are on to Rotary International with our Rotary Minute.
One of the incredible things about Rotary is knowing that there are people across the world who you can connect with. For me, that's just given me a sense of power and belonging. So I know that I belong anywhere. I know that I've got Rotary friends everywhere. Knowing that you've got a global reach of people who are like-minded, that's the wow factor.
Rotary is one of the most powerful international organizations that a young person can be involved in. It's one of the world's largest humanitarian organizations, has a membership of around 1.2 million members. It's located in over 200 countries and geographical regions. Pretty much any country you can think of, there'll be a Rotary Club there doing work in the local community, as well as connecting to each other across the globe, working together to make the world itself much better.
As Rotarians, being able to do things like start projects that have global impact. And I always talk to people about end polio now, because we wouldn't be where we are today in terms of polio in this world without Rotarians starting a project. For me, that's the power in everything that we do.
You have this incredible organization, this incredible network at your disposal where you can learn from, engage with, run things through the organization. Rotary has 7 focus areas where it focuses its energy and its time. Those key areas are disease prevention and treatment, peace and conflict resolution, water and sanitation, maternal and child health, basic education and literacy, and economic and community development. And then this year, a new key area was added, which is the environment.
Rotary has changed my life because it's enabled me to help more communities and more people. Rotary is relevant in our own backyards and it's relevant right across the world. I think the way that we're working now as Rotarians and Rotary clubs is really changing, not just because we're in the middle of a pandemic, but because we're really thinking more about how we bring people into Rotary and let people know that Rotary is for them. It's a great way, first of all, to meet people, but also to do good work in your community. It doesn't matter who you are, if you have got a heart and mind for giving and helping communities and working with people. Yes, Rotary is for you. That's what Rotary is. So yes, it's for everybody.
And that is
Here's
a
why I
Rotary
threw away
meeting.
all my blood pressure meds.
There we go. We got to stop that from going on. Hey, so now we go around the wheel and we talk and welcome all the Rotarians who are present and we make our introductions. I am the president, Raymond Foster. Fourth time, pretty soon to be over in about 9 months, thank goodness. Next up on president is Steve Scott. Hey, Steve, say hello.
Everyone, my name is Steve Scott. I'm the current secretary of the club, three-time president, about to be four. Been a Rotarian for about 13 years, and I'm a State Farm agent in San Dimas. Happy to be here today.
Excellent. Thank you, Steve. Diva, I'm glad to see you here today.
Hi, everybody. My name is Diva Alfaro. I keep saying 3 years, but I think it's closer to 4 now, maybe even 5. I think I lost count. 3 to 4 to 5 year Rotarian. I am a licensed loan officer. I specialize in reverse mortgages, and I'm glad to be here.
Excellent. Mike Wallace, welcome.
Thanks, Raymond. I'm Mike Wallace. I am the president of Better Home Financial, downtown San Dimas, mortgage brokerage, real estate brokerage. Proudly serving San Dimas for about the last 35 years. Been a Rotarian for about 7.5 years, and past president, past treasurer, and just happy to be here serving the community.
And Mike, you were, since our last meeting, in addition to Operation Cleanup, you were at the site visit at 29 Palms. And how did that work out?
It was hot. It was great. It was nice to meet up with Patrick and his coworkers out there at the Family Services Center, YMCA, on base at 29 Palms, and hear a little bit more about their current needs, and hear how our donation in February of 4 tons of food impacted the lives of the families of the servicemen and women stationed at 29 Palms. And it was wonderful that 4 tons of food is basically gone. So it's about time for us to do another food drive. And I know that's the focus of our satellite club. And but we got some great information, had a nice time out there, and we look forward to creating a permanent pipeline to fill the needs out there at 29 Palms.
In support of that, the USMC Dinner Committee will be meeting on September 6th. We've already received about $7,000 between sponsorships, donations, and ticket sales. We are 10 weeks away from the event, and we're 70% to the fundraising goal, and that supports 29 Palms also. That Making Spirits Bright is to provide Christmas gifts to enlisted Marine Corps personnel at 29 Palms and Camp Pendleton, as well as supporting the Armed Services YMCA. Also, the day after that, we'll have our regular meeting, but the Satellite Club will be meeting, and their job that day is to form the food bank committee. That's one of the things that they'll be forming up. And so we're moving forward into creating that permanent supply line and fixing the problem at 29 Palms. And by the way, we are up to 29 members. The Satellite Club has surpassed us now. That's very cool. Hey, Sylvia, you're here. What's going on with the Chamber of Commerce?
Hi there, I'm Sylvia. I'm the CEO of San Dimas Chamber of Commerce. And right now we are working on our wine and beer walk. It's happening on October the 1st. There are plenty of booth spaces still available. So if anybody's interested, please contact us at San Dimas Chamber. So the info at sandimaschamber.com or at 909-592-3818. Thank you.
Thank you, Sylvia. Once we get into September, I'll put a call for volunteers out. We will have a booth there at the event. I know many of the businesses that are downtown are going to be working that. So we need some of the people who don't have downtown businesses or food and beverage businesses to participate, so we can staff our booth and have a great event. But I know last year you had thousands of people walk through, and I bet it'll be even bigger this year. So that's a great event downtown. And so let's go over to our Satellite Club members first. Anthony Porter, how are you, Anthony? Please introduce yourself.
Hello, can you hear me?
We can.
Yes, I am doing well as a new member. I appreciate everything. Got one more week of my broken foot, so other than that, also work with the local PTAs, San Dimas and Lone Hill, and the president of the Laverne San Dimas Educational Foundation. So if you guys ever need anything, let me know.
Well, we're glad to have you here. We hope your broken foot heals up so we can see you out in the street with us very soon. And we're also especially pleased now by having you here. We'll have a closer relationship with the Ed Foundation, which is one of the goals we've had for a very long time. Our last Rotarian, last but not least, Isabella Foster, the secretary of the Satellite Rotary Club of Military Family Support.
I know it's a mouthful, huh? Hi, I'm Isabella Foster, like you stated, current secretary of the Satellite Rotary Club of Military Family Support, bartender, office manager, security guard, you know, and I forget my other job, but yeah, it's good to be here.
Well, we're glad to have you here also. I'm particularly glad to see you here today also. So we have two things before we go to our visitor. First is our visitors and our speakers. The first one we already spoke about was Operation Cleanup. First off, thank you to everyone who was out there. That was hard labor, but that's what Rotary is about. We pick international as well as local service projects. And it was really cool to work with other organizations, meet other people, and just work alongside them. And they provided donuts and coffee and pizza too. So they got a thumbs up for that. Congratulations to everyone with 29 members, 2 new members who were proposed and accepted yesterday. The growth toward 50 is happening. And once we reach 50, it really is a breaking point, a turning point for the club itself. It's a real pivot for us. Lastly, governor's visit. I'm going to keep harping on this. September 14th, we will be serving dinner. It's in person. It is mandatory. The governor's visit, September 14th. So let's go right to our visitors and talk about them. They are from Churchill Mortgage. Rick Mount and Mike Hardy are managing partners with Churchill Mortgage for the Pacific Southwest region since 2018 and have been in the mortgage business for more than 30 years. Mike and Rick co-lead a region with a production excess of 500 million in annual production, as well as personally originate over 100 million annually through Mike and Rick team, recognized as being the top 1% nationwide. They were fortunate enough to serve over 1,400 families in 2021 and have been business partners for over a decade. Kevin Sprague has been in the lending industry with Mike and Rick for 6 years since graduating from UC Riverside with a business degree. He loves helping home buyers accomplish their goals. In free time, he loves to watch and play sports, spend time with his wife, Ciara, and son, Owen. Welcome to the Rotary Club of San Dimas.
Hey, thanks, guys. We're happy to be here. As Raymond said, I'm Rick Mount and joined today with my partner, Mike Hardy and Kevin Sprague. So it's great to see you. I have a soft spot for Rotarians. My dad was a longtime Rotarian in West Covina. He worked for the Southern California Edison Company and then ultimately served on the Rotary board when he was part of the West Covina Unified School District board. And so I remember as a youngster being dragged to some of the Rotary events and the good that they do in the community. So it was fun to watch that video of the outreach you guys do. But we're honored to be here. We've been talking a lot about what's going on with real estate and interest rates and potential recession. And we've done this particular podcast or presentation now probably I don't know, a couple dozen times now, and I've had some fairly large audiences. We had a national audience of around 1,500 people, and Mike and some of his quotes have been picked up by Fox News and some of the other things. So we know it's something that's on everybody's mind, and I'm sure Mike Wallace, good to see you. We've met a long time ago, and so it's good to see you. I'm sure Mike will weigh in with some opinions on this as well. But I'm going to turn it over to my partner, Mike Hardy. We're just going to talk about the state of the housing market and kind of some of the underlying things that aren't always talked about in the media. And some of the things out there. There's a lot of fear out there. There's a lot of psychological warfare going on with the consumer's mindset. 2008, 2007, that era starts to pull back in. And so we're just going to talk about facts, not feelings. So Mr. Hardy, I'm going to turn it over to you.
Excellent. Guys, appreciate the opportunity to be here. Raymond, thank you so much for the opportunity. This is called facts, not feelings, okay? We have a saying, which is math tells a story. We're going to get into some of the data to walk through what's happening in real estate and even get some forward-looking perspective. And so just to kind of like preface this, and actually just to clarify, guys, should we be wrapping up about, it's about 20 minutes. So let's see, 12:35, is that about right?
Yeah,
Raymond?
about minute 35, and then we'll have plenty of time for questions.
Okay, perfect. So just a little bit of background. I grew up real poor. So I remember living in a trailer. My sisters and I were sharing one end. My parents were in the other end, this little tiny hallway. And so I remember when we bought our first home, it's like the world just opened up for me. And I remember as a kid having my own room, and all of a sudden, like I could just think clearly and opportunities just presented themselves. And so there's really two things we want to talk about today. One is the safety and security of real estate. And then two is, like, if we, think back to Maslow's hierarchy of needs, is the legacy building, okay, and the self-actualization, the investment side and the growth side. And so we're going to look at both sides, but specifically, we want to answer this question. We've been doing this. Is 2023 going to look at all like 2008? Okay, it's what people are wondering. It's what they're wanting to know. And there's a lot of confusion out there. So what we're doing is we're going to dissect the basics of supply and demand, get into the weeds a little bit, and then maybe do some Q&A. So the questions are, what about how, like, are we in a housing bubble? And I think it's crazy, guys, when we see that 77% of consumers think we are in a bubble. Okay, and think about this. If all the consumers get their information from real estate professionals, the stats we see show that 44% of real estate professionals think that a housing bubble is here to some degree. There's just so much uncertainty. So let's get into this. Kevin's going to talk about interest rates, and we're going to get into some demographics. Kevin, over to you.
Thank you, Mike. Thank you, everyone, for having us. So the first thing we want to talk about, we'll touch on each of these topics really briefly, and then we can go deeper in questions. But interest rates on everybody's mind right now, right? You can't jump online. You can't look at the TV without seeing news about interest rates, and for good reason. This chart shows interest rates from 2020 until now, and it's a little bit outdated. It's actually gone up a little bit in the last few weeks as well. But you can see rates have gone on a 30-year fixed mortgage from the 2s and the 3s now into the 5s, approaching 6, depending on the day. That's a huge jump in a short period of time, and that creates a lot of fear in the market. And a lot of buyers right now are not buying or are hesitant to do what they want to do because of rates. Affordability is a big deal. We'll talk about that in a minute. Interest rate has a big part of that. But some perspective we try to show people too is, let's look out at rates over 50 years instead of 2 or 3 years. Yes, we've seen a sizable jump. You can see that on the end of the screen here, but we're coming off historic lows, and we're still, relatively speaking, at a low point long term. So again, we'll dive into the affordability and how this impacts that, but we think it's really good perspective to start with. Again, facts, not feelings. Are interest rates high right now? They're high relative to the last couple of years, but they're not high relatively looking back over a long period of time. So we'll dive into the supply and demand and how this affects it, but we wanted to start and kind of hit rates right off the bat.
All right, next slide, guys. Check this out. One of the things I think is fascinating is looking at waves of buyers coming into the marketplace, because all price is obviously going to be a function of supply and demand. And so take a look at this. You can see the silent generation, the baby boomers, X generation, millennials, and then post millennials. And I want to draw your attention to something that's pretty fascinating. If you look right to this first red arrow in the circle, you can see 33-year-olds in 2006. Primarily, people buy real estate when they're in their early 30s, okay? Overwhelming majority, family formations that take place, okay? So that's one of the things that happened back in 2006, is there's a dramatic fall off in buyers. Look at where we are today. We have a pretty significant increase and continued increase of new buyers pouring into the marketplace, okay? Price is a function of supply and demand. So right now, we're looking at the demand side. We had a demand fall off in 07 and 08 that happened to coincide with a whole bunch of other things we'll talk about in a minute. But look at the buyers pouring into the marketplace today, followed up then by the post-millennial generation, Gen Z. So we have a lot of buyers coming in to the marketplace. Let's talk about some inventory. Kevin, back to you.
Thanks, Mike. And yes, supply and demand is what we're on right now. This is number of households nationwide, not necessarily all buyers, but check this out from 2007 till 2021, continuing increases in potential demand. We think we're much more solid this time around with potential buyers, like Mike was talking about, than last time when a crash happened after a similar run up, which we'll talk about in a minute. The big question is, if there were equal homes for sale now versus then, we have many more buyers now than we had before. If you've tried to buy a house in the last few years, you know there's not equal amounts of homes now. So to talk about the inventory, the supply side, Rick, I'll turn it over to you if that's okay to talk a little bit of what we're seeing on inventory levels. This has bounced around a little bit the last couple of years, but it's a totally different picture than it was leading up to the crash, which is going to dictate what happens with pricing next. So Rick, I'll turn it over to you for that.
Yeah, thanks, Kevin. Real estate often is driven by supply and demand. So one of the things that we pay attention to is the months of supply that's available and what the demand is to consume that month of supply. So when we're talking about months of supply, it's what's the demand and how many months will it take to absorb that demand. And so if you look at this slide, the red bars that are right there in the middle, that's sort of the month's supply that were available 06, 6.5 months supply, 07, 08, 09, 2010, 2011. You could see all well in excess of 6 months of supply, and normal market supply is 3 to 6 months. And so if you look at 2019, 2020, 2021, we dipped below the threes. And in the beginning and during the pandemic, we had less than 2 months supply, and in some of our localized markets, less than 1 month supply. So demand was really high and inventory was really low. Today, we're sort of creeping back into the 3% or 3 month range of supply and demand, which is starting to move us more towards normal. I heard it said the other day, it's like prices aren't really declining, they're just decelerating. So it's kind of like being on the freeway going 85 miles an hour, but now you're slowing down to 55, which is normal. And so that's kind of what we're seeing on the demand side. So there's also some other things, Mike, you want to talk about the housing starts and building permits, because that's another area that affects supply and demand as well.
Sure. So guys, this is really interesting. This is looking at new housing permits and starts all the way back to the year 2000, and then following up through just the start of 2022. And I want to draw your attention. If you could have an invisible line that went across the screen, that's kind of where we need to be in order to maintain the existing supply and demand. Look at this gap that fell off right at 2006 and 7 when builders just stopped building. And so we are in the process of making up inventory that's desperately needed. So right now we're kind of on pace, but the point is we have so much makeup to do. I've seen different stats somewhere in the range of 3 million to 4, even 5 million. There's a few different sources, so I don't know exactly where it is, but there's many millions of homes that are still needed to be made up from that window of time from 2007 up through about 2015. So I think this is interesting. The question is, what's scaring people? Okay, so let's look at this, guys. We see headline after headline. In fact, let's go to the next one, Kev. Wave of foreclosures are coming. I want to talk about foreclosures for a minute, because one of the things that we've seen headline after headline is waves of foreclosures are going to follow this housing market boom. So we want to look at the year over year 30,000 foot view of foreclosures that are happening. This is from Adam. Those of you guys that are data geeks here. Look at the surge of foreclosures that's happening to the far right of the screen. Okay, this is taking us back. I can barely see it even with my glasses. Kev, does that say 2002?
2005.
2005. Okay, so this is 2005. You can see the peak of foreclosures back in 2008 and 9. Then we start dropping way down, and then of course we have a freeze or a moratorium on foreclosures called forbearance, where during the COVID era, where all of a sudden, if you weren't able to make the payment, you just didn't have to. Okay, so now we're starting to see some of that come to fruition. But the point, guys, is people are scared because they're seeing all these headlines over a surge. We're actually way below the typical 1% run rate of foreclosures that exist across the country. We're right now 0.6, 0.7. So we always want to look at some of the data from a 30,000 foot perspective to see what's really happening. Now let's talk about forbearance. Rick's going to cover this one for us.
Yeah, so forbearance, guys, a lot of times what happened in early 2020 in May is there was a lot of voluntary entry into forbearance. Right, the government put out there, because the pandemic we didn't know what we were dealing with. A lot of people that didn't need forbearance went into forbearance voluntarily because they're like, I don't know if I'm going to lose my job, might as well protect myself. And so what we've seen is sort of this really soft unwinding of people that entered into forbearance, nearly 5 million people in May of 2020. But if you look at April of this year, which is the last reported statistics, there's about 600,000 people that remain in some level of forbearance, which is still well below the averages. So, when you see a sensational headline that forbearances are surging and foreclosures are surging, well, it's relative to what they're comparing it to. So when we kind of look at the underlying data here, the forbearance number is kind of like a tear in the ocean. It's really not going to have much impact on supply or demand that will affect pricing, or certainly not create any type of crash. The next slide also talks about the difference this time around is the general American home and the equity position they have today versus 2007, for example, pre-crash. So in 2007, the actual or the average equity cushion was around 37%. Today, the average equity cushion is around 68%. So there's much more of a cushion that will prevent people from having to do forced or fire sales or short sales or end up in foreclosure because they just can't sell the house for what it's worth. You know, you also look in 2009, 26%. So a little more than 1 out of every 4 homeowners was literally underwater from a value perspective of what they owed on their home versus what today it's less than 1.5%. And then if you look at kind of the mortgages, which is another data, going back to that last slide, 95% at least have 10% equity, and 37% of the households in America today have no mortgage at all. So radically different condition going into this as we are on the next one. So Kevin, go ahead on the next slide there.
Yeah, this is just another way of illustrating it. Mortgage debt has remained somewhat constant overall with some fluctuations, but homeowner equity with the run up in prices the last few years, the lack of supply for buyers, prices have driven up. So we think a wave of foreclosures is not coming in the same way as before because it's so much more solid from a foundational standpoint for homeowners. Also, a couple big factors that impact that too. The quality of loans that we as lenders are writing are much different now versus the lead up to the crash last time. One of the big reasons we crashed is that when the Fed started raising rates aggressively, people's payments went up dramatically because a lot of people were on adjustable rate mortgages. They qualified without having to prove income or credit worthiness. This is one chart that shows the amount of loans being written with low credit scores, so to speak, which is one measure. And then from a lending standard, the risk of the borrower is much lower because we're qualifying them now differently than before, but also the risk of the products. Almost everybody's on fixed rate mortgages right now. So as the Fed raises rates, your housing payment doesn't change if you're on a fixed rate mortgage. Whereas before, when that happened, the adjustable rates went up and up. So I'll turn it back over to Mike for a little more detail on this, but we think the quality of loans and the quality of the actual lending standards are much different this time around, which will prevent a crash.
So guys, I grew up in New York and Connecticut. Think of, I don't know if those of you guys have been ice skating before, but think of the red here as like skating on thin ice, okay, the product risk with the, as opposed to the borrower risk. And guys, big difference right now. Right now, there's somewhere in the range of 3 to 5% have adjustable rate mortgages, but closer to like less than 1% have annual or monthly or yearly adjustable rate mortgages. The rest are fixed, okay, fixed for a window of time. So a huge difference between product risk and borrower risk today versus back in the past. Let's go to the next slide. Many of you guys are fans of The Big Short or read the book or saw the movie. I'm actually reading it for the 3rd time right now. One of my favorite. I love Michael Lewis. Look at this. Michael Burry, who is one of the key characters in the book, he's the founder of Scion Capital, says something really fascinating. Home prices didn't crash in 07 and 08 because they had climbed so high. Home prices crashed because, among other things, borrowers could not make the payments. Okay, so a lot of people see a run up in real estate back in 05, 06. They see a run up in real estate today and they say, I've seen this before, we're going to crash. So what we're doing is looking under the surface to show what's different and why it's different. So very different world today. All right, now let's get into where some of the challenges are. Okay, it's not all roses and sunshine out there. We've got some challenges. Okay, the biggest one we're facing is affordability. Okay, affordability. What does that mean? Who can afford to buy a home? It's a small percentage of people. What is that going to do to real estate? Is it going to cause a crash? So let's look at this, guys. This is an interesting slide because it shows home appreciation from 06 up to today. It shows an appreciation of 73%. 248 up to 429. What we also have to factor in and keep in mind is what has happened to wages. Okay, what has happened to wages? Wages, 59% increase across the board. Let's look at the monthly payment. $1,190 up to $1,900, close to $2,000. So the point, guys, is we're starting to see a cap on affordability, which is going to significantly limit and slow growth. Doesn't mean we're going to have a crash. If rates go and have some significant run up from here, well, that puts us in a more dangerous position. But where we are right now in the 5 to 6% range, it just means fewer people can buy. But guys, keep in mind, for every home that's available, there's 1.5 people that want to buy that home. We have a supply and demand issue. Okay. All right, let's look at the next slide. Kevin, why don't you cover this one? And
yeah, this is a similar way of illustrating it. It's showing the home, on average, the home payment compared to household income. And you can see on this side of the chart here recently, because interest rates dropped so low, homes were very, very affordable for a period of time compared to more historic averages, driving up prices that people were able to pay and offer. Now we're back to an area where it's getting a little concerning from an affordability standpoint, which is slowing things down a little bit. We think it's different than a crash. Like Rick talked about earlier, a slowdown, a correction is different than a crash. But this kind of just illustrates it a different way. And maybe to wrap up for the last 5 minutes, Mike, I think what might be really relevant to talk about, how does inflation and a potential recession impact what we think is going to happen next?
Yep, let's look at that, Kev. Good thinking here. So, all right, inflation, guys, inflation. Well, fascinating. Real estate is a time-honored hedge of inflation. So one of the things, in fact, let's jump to slide 24. I want to show like year over year real estate and inflation. If you look at this, guys, what we're really wanting to know with real estate is it going to be a hedge against inflation? We see that. Okay, if you look at decade by decade by decade, and this is just also showing 2021, inflation rate's much higher than this now for 2022. We know it got up to 9.1 in the 8.5 range. We'll see where it settles with the Fed's action. But guys, one of the things that I think is not clear to a lot of people is that when there's inflation, usually hard assets, commodities, tangible assets tend to do very, very well. Okay, so we see real estate as a hedge against inflation at minimum. The big question with real estate is there's nominal increase and there's real increase. So we want to keep an eye on that, because right now what we don't know is if real estate will grow as fast as inflation. But what we do think is we'll continue to have, at least from real terms or nominal terms, some appreciation take place. Let's go to the recession stats. Kev, you want to start this one out?
Sure. So this is one thing that's on a lot of people's mind right now, is if we're going into a big recession or a small recession, who knows how deep the recession will be, but if there's economic challenges coming, that means I shouldn't buy a house, right? And that's not necessarily the case. Recessions are not always bad for housing prices. This chart illustrates it, I think, pretty well. These are 6 of the most recent recessions in the US over the last 40 years or so. There's only one recession, 2008, where housing really did poorly. At least housing stayed flat or grew during the other recessions. The big difference, 2008, it was caused by the housing market rather than the housing market having to react to it. Part of the reason home prices usually do well during tougher economic times is that very consistently here, you can see the last 6 times, mortgage interest rates typically fall either marginally or dramatically during these recessionary periods, sometimes because of what the Fed has to do, sometimes because of bond trading and stock market differences. But you can see mortgage rates typically come down during recessions. This next chart illustrates it as well, kind of over that long-term average. And that can make properties more affordable again and kind of hold prices steady. So maybe in conclusion, to kind of think through here, where we're going next does not necessarily mean it's going to be bad for housing. There's a lot of factors that play into this. And we still think it's a very healthy time, if it's right for you and your family, to start to look at the home buying process.
So, and on this slide, guys, and then we'll start to move into some Q&A. This is pretty fascinating, because each time we do have a recession, you can see in yellow, you can see the recessionary bands that there was a drop in mortgage rates. And right now, even back in the 2019 or 2020, there was a drop as well. Run to the next slide, Kev, if you would, number 29. I want to show the pattern with the Fed so we can see how this ties together, and we'll do a little Q&A. So look at this. Okay, so the Fed and their actions to get in front of and tame inflation have been, headlines recently. Look back to the Volcker era, and you can see what happened to inflation. Went from 7% up to 14. What happened to mortgage rates? They went from 12 to 18. How about the federal funds rate, which is what the Federal Reserve controls, federal funds and discount rate? They torqued it from 11 up to 20 in a very short time frame. What was inflation's response? Came from 14% down to 5. What happened to mortgage rates? 18 down to 12. Okay, so the point, you can follow that. You can see Greenspan's actions across the board, and then Powell. So what we're seeing is with inflation, 1.5 up into the nines. I mean, it's a debate where it truly is, but we saw mortgage rates increase. Why? Because inflation got in front of it. Now, where does the federal funds rate go and end? We'll find out. But what we do expect is as they get in front of it and tame it, that is going to have a positive impact on mortgage rates, meaning they drop, because mortgage rates are going to be very closely correlated to the expectations of inflation. So I know there's a lot to unpack here, but what we're trying to find out, if you go to the slide 30, is what is going to happen with real estate? Is it safe to buy? Is there going to be a crash? What do I need to be concerned about, guys? And the reason we do this is because we fully expect there to be a slowdown in appreciation. I even think some of these forecasts might be a little bit aggressive. Obviously, real estate is regional, okay? But there'll be a slowdown in appreciation. There already has been, guys. But the point is, in the past, for every home that was for sale, guess what? For every 100 homes, maybe there was 70, 80 buyers. What happened to the prices? They came down significantly. Now, for every 100 homes available, there was 200 buyers. Maybe there's 120 now. Okay, my point is the supply and demand are what are going to drive the price. The affordability is going to be a factor in that. We want to keep an eye on interest rates, but we're expecting as we roll into a recession, depending on what the Fed does, that's going to have some relief on mortgage rates. That's what we're expecting sometime over the next 12 to 18 months. So let's go to Q&A. Guys, thanks for allowing us to present. This is like an hour talk. We tried to get into 20 minutes, but thanks guys for having us. Let's do some Q&A.
Well, thank you for the presentation. There is a lot in there. I'll open up to questions. And so let's first unshare the screen there so that we can get everybody. There we go. Got everybody's smiling faces now. So questions, because I've got a few if nobody has any. First question is, what pressure do ADUs have on all of this, especially locally? If people are, construction is going to be redirected to ADUs. ADUs are going to create more housing. People are making different choices. I know several of my neighbors are beginning that process. I'm just wondering how that's going to impact this whole process.
Great question. You know, we need the inventory. Bottom line, we need the inventory. I would think, I haven't looked into the data on this, but I would just think, just doing some napkin math right now, that it's going to take a few years for, you know, the ADU flexibility to have a material impact on what would be normal supply and demand. I mean, it's not necessarily a simple process. I think it certainly helps. Even in, I mean, it's interesting when we look at the demographics of California, this was the first year that we actually had a net negative decline of population in California. I mean, we're pretty close to 40 million. I think we lost, you know, 500,000 folks moved out, and there's maybe 200,000-300,000 that moved in. So California is kind of an interesting animal. It's if I'm remembering correctly, about 50-55% home ownership versus rental. But we need that inventory either way. Other states need it worse than we do, but I'll keep an eye on that because I'm curious on that. I mean, I'm an investor as well, so that's very much near and dear to my heart to see how we can improve cash flow opportunities, you know, with ADUs. So great question.
Okay, second question, unless somebody has one, because I'll keep going here. I got a couple more. The second is supply and demand conversations are interesting, but I'm wondering in the home buyer, not the home investor, not the guy that's going to flip properties, but your average family that's looking for a home, in that rational choice to buy a home, how much of fear of, well, I might buy a house at this price and it might be worth $100,000 less drives people, because that is irrational.
You know, the markets are driven by fear and greed. You know, at the end of the day, we're human beings and we're wired to react, usually to jump for an opportunity or to move away from pain. But I think that's one of the challenges we have. And part of the reason that we've been doing these presentations is just to speak the facts. The headlines are just so, they're meant to attack, to collect eyeballs, and they do, but it scares people into doing what's best for them. The concern I have for folks is folks that are renting, it's almost like having a year-over-year adjustable rate mortgages. I mean, the price of real estate and rents are tethered together over time. Usually there's a 12 to 18 month delay in rents to catch up to the effective cost of real estate. And so what happens to folks that can, what we want is people that can buy and should buy, they should be buying, because we know that over the last 100 years, the trend line for real estate is about 4 to 5%. Every 15 years, the values are going to double. Real aggressive markets, it'll be 10 years. Slower markets, it'll be 20 years. But the point is that there's more there's more millionaires made through real estate than really any other area over time because of just the way that our economy works. So you strike a chord, I think, with all of us on this call, because what we don't want is people that have the ability and capacity to build wealth for their family to miss that window.
You answered my question in the way that I actually see it, in that I don't know that the average person is going to buy a home is looking 30 years down the line of what it's going to be worth. When you buy a house, you've got kids, you're looking for a school district, you're looking close to work, you're looking where the shopping is, what's the transportation, and then you're saying, okay, we'll stabilize my payment for this period of time. And if the house goes up or down over the 30 years you intend to stay there because you're buying a lifestyle, then it doesn't matter. It doesn't matter till you cash out. It's like any investment. So I want to hear people talk supply and demand, or, this house is going to go up or the price might fall. I don't know that conversation. I don't know that it strikes with people. Or strikes the wrong way. If you can't, I think your message, if you can afford and you haven't bought a house, well, that's craziness.
Right. I think what people need to know is that the alternative, I mean, there's two options. You can buy or you can rent. And so that's it, unless there's another option coming down the pike that we're not aware of. But on the renting side, it's what I've noticed is that affordability limits appreciation. But one of the other things, if there's too much of a disparity between the cost of ownership and the opportunities to rent. So when people see a house that they want in the district that they like, that's the community they like, really, they're going to make an assessment of payment. Right. And the payment is, okay, if I buy, it's $4,000 a month. If I rent, it's $3,000 a month. Maybe I'll just rent. Like that's just human nature, right? Well, but not understanding that rent's going to be $3,500 and then $4,000 down the line. So,
and I know this isn't your job. It's probably my job as the grandfather and the father to say, when you buy the damn place, you own the place. And when stuff goes wrong, you got to fix it. And there's a lot of stuff to home ownership that people don't think about, but over the long run, it washes out. Anybody have any questions? Otherwise, I will monopolize the conversation for the next 5 minutes.
Yeah, I'd just like, I hear every realtor, every loan officer out there saying, we're not going to have a crash. We might have a correction. We might have a downturn. Can you define how you define a correction versus a downturn versus a crash?
Ooh, great question. Great question. So
whether I own the house or not, that's
that's right. That's like a recession is when your neighbor loses his job. A depression is when you lose your job.
That's right.
Yeah. So yeah, in my mind, so there's a couple moving parts to this. And I think one of the challenges is a lot of times people see like a peak value and they don't think like annualized. All right. And so that's something that we want to keep in context. So in my mind, like when you start to have greater than 20%, that's sort of crash territory. When you're in like 5 to 10%, that's kind of correction territory. But what we have to keep in mind is you could have a property that was, in fact, Rick and I were just talking about this the other day. You could have a property that was at 500,000 value, and then the neighbor said, heck yeah, we're listing for 550 and it's getting nothing, right? Or maybe there's somebody that came in that threw money at it and bought it 550, but it's kind of like you go to the Porsche dealer and they're selling for an example of a friend of mine. He went to the Porsche dealer and it was like $50,000 over sticker because of this crazy supply and demand imbalance. Okay. Usually the Porsche is going to be at, 200,000 and then it's going to be at 210. It's going to move up sort of with the inflation, but they were selling at 250. Does it mean that 250 was a new price, or was that just a false price that was put in place by the psychology of I'm going to miss out and overpaid for a property? Yeah. Okay. So there's a lot of moving parts to it, but if I oversimplify it, in my mind, 20% plus we're crashing, 5% is a correction.
Okay, final question from anybody before we get to the wrapping part of the meeting, because there's a few things to do, and I invite our guests to stay because we've got lots of interesting things going on for the next 10 minutes or so. Final question. Thank you so much. It was very informative and very thought-provoking. And so I sincerely appreciate you guys being here and being in the community. So let's go on to Action 360. Our Find Master is not here today, but is there anybody with a overwhelming desire to find themselves for something they've done? By the way, those of you not Rotarians, that's the way that we raise money. We all agree to a certain amount of fines per year. And so anybody here have a overwhelming desire to tax themselves for their behavior?
I'll find myself $10. Had a great time out there at 29 Palms. It was definitely good, like I said, to meet up with Patrick again, and hear firsthand all the good that the food drive did. So yeah, and Raymond, especially appreciative of you playing taxi for the day, getting two of our older Rotarians who did not have transportation out there and back.
I tell you, Mike, I'd find myself, but that trip cost me $400 because about a half a mile from the base, there's a casino. Casinos are conditioned, allow you to smoke indoors and sit down. And so the trip was actually more expensive than it had to be for me personally. And by the way, Patrick will be the guest.
$200 more.
Patrick will be the guest of Satellite Rotary Club for their hybrid in-person Zoom meeting at the brewery on, I believe it's the 17th. And so that's to ask follow-up questions for all the people that they've had time to digest that trip. Diva, did you have something you wanted to find yourself? You unmuted yourself.
So I'm gonna so find myself $10. I actually had the privilege of taking my parents, my mom for her birthday, to the Magic Castle. If you've never been or you don't know, it's like this cool castle in Hollywood. It's magicians only. You have to be, either a member or invited by a member. And I happened to be invited, so I took my mom for her birthday. They had a great time. I got to take my daughter. So we went to the brunch, and she's not 18 or not 21. So we had a great time. It was a lot of fun, and considered to becoming a member until I saw how much the fees were, and I was like, yeah, no. Stick with Disney.
That sounds like a great trip. Every Angelino should go to the Magic Castle at least one time. So closing out the fines, going to Action 360. This is 360-degree action we have going on in the community. First is the raffle is still going on. Each of you has 100 tickets. I hope you're selling them. Now is the time to begin to turn in your money so we can deposit it in the foundation bank account. You are going to sell all 100 tickets, but as you sell them, I need the money. The prize is a $10,000 diamond ring. The drawing will be in early December. We have a number of Rotary clubs and other organizations participating with us. If anyone would like to participate with us, what we do is we give you the tickets. You sell them for $5 and your nonprofit keeps $4 and our foundation gets $1. That's a heck of a deal. So we're here at the Rotary Club, San Dimas Rotary at gmail.com. Shoot us an email and we'll get that taken care of. Governor's visit 914, that's in-person. Dinner will be served. Attendance is mandatory. We will be inducting 6 new members at that, which is really cool. Foundation status. The foundation, of course, is doing very well. The investment account was established. We've been depositing money into it from a variety of donations that we've received. So that's looking very good. We also have Eric Nakano, the city councilman, will be the community board member. Glenn Johnson from the Satellite Rotary Club. We will hold a foundation board meeting just prior to the end of October, because I suspect that we're going to raise more money than we anticipated for the Marine Corps dinner. And therefore we have to decide what the split will be, but this is a good problem to have, is how we divvy up money. So that's very pleasing. 2026 committee is meeting next week. Satellite Rotary Club doing fabulously well. They have now 15 members, I think, 15. Now we're in the process of building a Rotary Club. So we're teaching them how to do things. What they'll be doing now next week, or the next meeting, is forming their first committees. I will tell you that it's been good with the officers that they currently have. I've spent a lot of time with mentoring them. So as they get their Rotary Club meeting up and running, if you can come over to the brewery when they have their in-person meeting, dues are only $15 a month for that Rotary Club. And why somebody wouldn't want to be a Rotarian for $15, I do not know. So that's looking good. USMC Benefit Dinner Committee, I told you that sales of sponsorships are doing very well. Some of our last year sponsors have said, just rerun my ad and send me a pledge. It's really cool to have Barbara, our treasurer, and she's just emailing people and they're paying. Hey, fashion show, Barbara, Diva, that's on my list here. You have a date.
Yes, we have a date. June 10th, which is a Saturday at 10 a.m. Just need to again confirm with the venue, and then from there, and I guess at this point, then we can get everything kind of rolling of getting vendors booked and talent meeting models and MC and all that. So I'm glad that that hard part is taken care of. So now it's just a matter of walking the venue and then full force getting everything going.
So we'll call another committee meeting. And for those of you unaware, the fashion show that we're going to be conducting will benefit the House of Ruth, a domestic violence shelter that services our area. It is nearby. And so we're excited to conduct this fashion show with name brand fashions and hopefully high school students as models and local businesses providing the makeup and the hair. And then we'll look for sponsorships and vendors, and we're going to make a ton of money for the House of Ruth, which is very cool. Anything else on the fashion show?
Yeah, if anybody knows anybody that would be great to be an MC for the fashion show, that'd be great. The bigger the name, the better. Or whoever if you know somebody that knows somebody, make that call and see if they're willing to be part of a great cause.
Yeah, let's cast a really wide net on that. The dinner that we're having is our second annual Marine Corps dinner, and that event has essentially tripled in its income. And we're really souping it up with the dinner and the speaker and all those different things. And the fashion show is our first year, but reaching out and getting an interesting master of ceremonies would be a real coup for that. So put your thinking caps on. If you know somebody who would be great at that, let us know. Thank you, Diva. Last thing to talk about at Action 360, it is that time of year again, C's Candy. We have not focused on this. We're not going to do it in person, but we will have through the domain supportrotarians.com. Beginning tomorrow, we'll default to a C's Candy sell site where you can buy it online. This year, I've titled the store Military Family Support. And so that'll give us the opportunity to spread it through our different veteran agency partners. And do the same split, 50% to the Military Family Support Rotary Club, 50% to the foundation to fund all the other good work that we do. Seems like a fair split, but C's begins tomorrow. And I will get the information out to everybody via P-mail as soon as possible. So before we go to the four-way test, does anybody have anything they want to say? Excellent. Oh, Mike, I see.
Actually, yeah, I should have used my fine for a big "I told you so" to you, Raymond, because when the satellite club started, you said, "I think this satellite club is going to be bigger than our club in a year," and I said, "I think by December they're gonna dwarf us," and they've already surpassed us.
They have, and I appreciate all the hard work that their club has done in recruitment. And the Satellite Rotary Club of Military Family Support, for those people reviewing this and our guests, is the first time Rotary's allowed something to be done in that the Rotary Club is a satellite club, so it has lower dues because it benefits from our infrastructure. Number two, it is a single issue club, and it is designed to support military families, both active duty, National Guard reservists, and veterans. And it is designed non-geographically. So it's the first Rotary Club in the history of Rotary that doesn't have the name of a city or a place in it, as Covina Sunrise or Glendora or San Dimas. It's the Satellite Rotary Club of Military Family Support. And one of our new members is in Las Vegas. And one of our members that joined up is in San Dimas, and another is in Eastwood, and another's in Riverside, and a few more in San Dimas. So it's really spreading very quickly. And that's a great thing. So thank you, Mike. So we go to the four-way test. Does anyone want to volunteer? I'll put it up on the screen and you can read it. This is the ethical test that we Rotarians use in not only our business dealings, but our daily lives. I need a volunteer. Volunteer, someone who can read. Do we have anyone who can read? I see you snickering, Sylvia. The snicker's going to unmute yourself and read the four-way test to us.
No, I'm terrible on this, but I'll do it. Okay. In 1932, Rotarian Herbert J. Taylor created the four-way test. The four-way test is a non-partisan, right? Okay, non-secretary. You see, I'm terrible. Ethical guide for Rotarians to use their personal and professional relationships. The test has been translated into more than 100 languages, and the Rotarian recite it at club meetings. The test asks the following questions: of the things that we think, say, or do, is it the truth? Is it fair to all concerned? Does it build goodwill and better friendships? Will it be beneficial to all concerned?
Thank you, Sylvia. And I know I put you on the spot with that, but you did a fabulous job. In fact, you may actually be our four-way test person in perpetuity now. So.
Oh, no.
Thank you very much. Anybody have anything before we go? It is minute 55. We're right on course. Thank you so much. I will see everybody in a couple of weeks at our next Rotary Club meeting. If you'd like further information about us, visit us on the web at sandimasrotary.org. Contact us at sandimasrotary@gmail.com or call us on the telephone at 909-599-7530. Lastly, if you light a large enough fire, one of us will show up and help you put it out.